as a math person or as a scientist, that is my best leverage or my best advantage in this crowded space. Because anybody can buy a home at any price, right? Because it's a supply-demand market. Whoever pays the highest get the property, but it doesn't mean that the person who pays the highest makes the most money. Maybe just the person make the bad decision of paying so high, right? So I think my advantage of my practice is actually the technology, the mathematic rigorous that gave me the most advantage.
Hello, everyone, and welcome to the Journey to Multifamily Millions. I'm your host, founder, and CEO of Zana Investments, Tim Little. And on today's show, we have with us Frank Xia, an ex-software engineer and data scientist. Frank is the founder of Daytona Capital. He has invested in everything from stocks and options to diverse assets like sports cards, watches, and of course, residential and commercial real estate. Frank, welcome to the show.
Thank you very much for having me today, team.
Yeah, and it's great to have you here. Frank, in addition to real estate, you are also a watch aficionado. Is that correct?
Yeah, that's correct. I'm glad you mentioned that. I collect a lot of luxury watches just for the sake of I like these mechanical movement. And I like the design of the watches. And magically, over the past few years, they preserve their wealth or they preserve their value super well.
Yeah, and so I should probably ask you what you're wearing right now.
I usually wear an Apple Watch at home, but usually when I go out, I wear like a Rolex or Patek Philippe.
Yeah, I'm right there with you. I've actually wearing my Samsung watch, but I have a Tag Heuer at home. That's my favorite that I've had for a long time, right? And that's the other thing about these watches. They can last a long time. I've never gotten really into Rolex, but I don't know. I'm thinking Grand Seiko might be my next watch. I think those are some beautiful
brand.
Pieces.
Yes,
All right.
I bought a lot of Grand Seiko in the past. Snowflake is my favorite.
Oh, okay. Yeah, I'm trying to think of, there's the one, because they have all the ones that vary by the season, and those are some really nice pieces. Yeah. All right. I don't want people to get confused into thinking this is a watch podcast, but we could go on for hours for this. But please get into the details of how you got started on your investing journey and your related background, and tell us how you got to where you are today.
Yeah, so my education is financial engineering. So by definition, people who has that degree goes to finance industry like Goldman Sachs, like the banking, iBanking. They also go to hedge fund, does a lot of investment. I'm the non-traditional route. I joined a tech company just because of I like the tech culture more than the finance industry. But in the mind, I'm pretty well trained for investing in general. And magically, over the past few years, the tech industry has been doing pretty well. I had 2 successful exits for IPO. So I'm very fortunate to accumulate a lot of cash. And I use my finance industry knowledge to help me to deploy money. And because of I was in the hedge fund before, I have the sentiment of there are just so many smart people out there. There's no way that I can beat them. So I don't really invest a lot of my own money into stock market. I usually just buy S&P 500, which is the Stanford 500 index, which is the market. I usually don't try to beat the market. And I'm always looking forward to find different asset that I can make extraordinary return on top of it. So real estate is one of it. Watches is one of it. Sports card is one of it. That's what I've been doing passively in the past maybe 5-7 years. So I'm very deep into investing. And my job also gives me good exposure to all of the technologies that's hot in the world right now. For example, AIs. For the past 2 companies, we use AI to literally price these alternative assets, right? We build up the pricing system for single family real estate pricing. Basically, the AI system is able to give automatic price for every single home in the United States. That's between 200 to 500K. And we build up these algorithms that can predict the price at relatively small era. Also, similar situation happened for sports car. We built an AI system that basically price sports collectibles that allows us to trade on top of it. So that's pretty much my journey. I'm a very math and engineer person in my mind, and I'm very number focused. And right now I'm transitioning to a full-time investment role that I allocate my own money and also help my friends to allocate their money into multifamily, and also sometimes other asset class.
Yeah, it's really interesting because sometimes when it comes to investment, people get stuck in their own little rabbit holes, their echo chambers where, maybe all we talk about is real estate and someone else, all they talk about is stocks. But you've really branched out into multiple different assets from the more traditional, your S&P 500, to very alternative sports cars and watches, etc. So it's interesting that you are so well diversified. And the other piece, when you mentioned that you didn't want to try to keep up with the people that you felt were smarter than you when it comes to like individual stock picking, right? But I would argue there's not that many people that are really smart at individual stock picking if you look at the statistics at large, right? Like most people are just not very good at it. So it is really smart if you don't have the time or desire to dig into every single stock that you're looking to buy, to just go into something like the S&P 500 where you could take advantage of the market itself without having to do all the work associated with picking individual stocks. And again, trying your luck, because a lot of times people are wrong because all it takes is one news story to throw a stock off kilter from what your expectations were.
Yeah, exactly.
Yeah, so let's go into the real estate piece. Tell me what your first real estate investment was and how you got started investing into that industry.
So I'm a very traditional Asian, and usually the family have a saying that you have to take care of yourself before you take care of your investment. So the first real estate I purchased is my condo that I live in San Francisco for a while. I actually sold it last year at losing almost 80% of my principal just because of I'm 20% down, 80% leveraged, right? And the house declined 10%, so I pretty much lose everything over there. That was actually a bad investment, but that was actually my first condo experience. And I obviously don't enjoy it because I have to pay a very expensive HOA. I have to pay relatively expensive tax. And during COVID, I actually was thinking about renting it out, and I'm actually losing a lot of money because I just wasn't able to cover my expenses versus my rental income. So that was my actually first investment, and I don't like it. And then I'm actually looking for, okay, I'm trying to think about, okay, real estate has been proven working. Why my condo doesn't work? And then I realized, okay, it's not about these luxury condos that really generate cash. It's about single family homes, multifamily homes in secondary or tertiary market that actually generate reasonable cash on cash returns instead of negative cash flow. So then during COVID, this is still during COVID, I started to acquire townhomes and single family homes in Sunbelt states. I started looking into Austin and Texas, but that was already too late. I was late in the game. People are already migrating into these cities, and the price has been hiked maybe 30 to 50%. And the numbers cash on cash just didn't make any sense anymore. And then I transitioned my focus into Tampa. So I met a guy on social media, never met him in person. He's a realtor. And I talked to him maybe for 10 minutes, 20 minutes. I pulled the trigger. I bought a lot of townhomes in Tampa, one by one, up until a point that my bank yelled at me saying that, hey, we're not able to rent your money because you haven't rented out and your debt to income ratio is too high. And then these houses are great because during that year, 2020 or 2019, the rent grows like extremely. 10%, 20%. That makes my cash on cash extremely well. I think I'm still netting 10, 12% a year on cash, regardless of the appreciation of the homes. So this gives me a lot of confidence, right? Versus my failure of my own condo. So I started to dig deeper into this multifamily or real estate thing. I started to look into duplex, triplex, and quadplex. I just don't have the experience, and I've never purchased old homes before because all of these townhomes are new builds, and my condo was new builds. I've never dealt with old builds before. So I get stuck because I don't know what kind of due diligence should I do, and I actually don't know what should I purchase. I don't know how the numbers work, etc. I don't know how to underwrite. And then I actually meet a friend or my mentor that directly was in this multifamily games. And I grill him for maybe 10 hours on how multifamily real estate works. And then I become his LP. He's actually the sponsor of a deal. And I invest 3 deals with him over the past few years. And we have 1 successful exit, which is pretty great returns. And we are still holding 2 just because right now the rate situation. So this gets me to the multifamily world. And I like it a lot because I no longer need to use my own money. Sorry, I no longer need to use my own line of credit to borrow equity. I can just become a silent investor or like a major investor that get a better terms, and I get my cash flow, I get my preferred tax treatment, and I can build up my wealth. So this is how I transition into this multifamily. It's just because of it's more efficient to deploy your capital, and the return is reasonably okay. That's how I end up with that.
Yeah, and there's some things that I love about that story. First, your first effort didn't go that great. And granted, it was your residence, right? You were living there, so you were getting something
Yeah.
out of it. But after that, you didn't just say, obviously, real estate doesn't work. I'm never going to do that again. You stopped and you examined the problem and said, okay, why didn't it work? You knew very well that other people were making a lot of money and there was tons of benefits to real estate. You're just like, what went wrong here? And then you pivoted to, like you said, those Sunbelt markets. And then we could talk
Yep.
about Tampa for sure, because that's where I'm based. And so I've seen it. I moved there in 2016, and I've just seen the housing prices and the rents just skyrocket since then. And a lot of that is due to COVID, right? It shot up like a rocket ship during COVID, which made it harder to buy once it did shoot up, right? But if you got in before that, you were in a very good position. And it sounds like you did get in before that. When did you buy? You said 2019?
2020, 21, 2020 and 21.
Okay. And do you
That's
still
the
own
time
those
I bought a lot
properties
of-
in? Do you still own those properties in Tampa?
Yes, it's actually north of Tampa in Lutz, so a few miles away, not affected by the hurricane.
Yeah. And so you have those, and that's, that's when you get down to, all real estate is local, right? You need to understand
Yeah.
your MSAs. Tampa is the MSA, but you have all these towns that surround it, which are still
yes.
great because you have a lot of especially I know a lot of military families that live in those areas and town and country. And there's all these different places because they can get a lot more house for the money out there versus being in Tampa proper. So you do have a steady stream of both buyers and renters in those markets.
Exactly.
Yeah, so that's awesome. The other piece that I wanted to get into is, why you switched. And you said part of that was because banks were yelling at you, which is understandable. Because debt to income ratio, you have to keep it at a certain point, and you were getting past that point, and they noticed. And I think that's something that a lot of people don't think about at first, because that's one thing that I noticed too, right? When I was like, okay, I'm going to start buying a bunch of duplexes. But it's the same as buying a single family house from the bank's perspective. They don't really care. But you are going to reach a ceiling, whether that's 10 mortgages, which seems to be the magic number. For most banks, they won't let you get over 10 mortgages, or whether it's the debt to income ratio. Whichever one of those ceilings, you're going to wind up hitting one of them. And so you transition to the more passive side. Now, do you still feel like you get a lot of the same benefits passively investing that you do with the active side of things?
I like it way better because I'm actually not active at all because I never been to Tampa personally, to be honest.
Okay.
And it's delegated to a property management, right? So they take care of the tenant part. But when you're doing single family or townhomes, your vacancy is still binary. If you hit like a 3 months of vacant, it pretty much eat up your entire year's profit. That's the thing that I really don't like. So that's number one. Number two is that as the owner of the home, I know there's like a way you can transition, you can move your property into an umbrella of LLC to protect your own asset, but I'm still technically liable for the danger or damages for the tenant that lives in there. So there's a certain exposure of risk that I have to, and also just acquiring homes, it just like buying one home at a time just slow. So that's pretty much the downside I don't like about single family or multifamily. Sorry, like a smaller size of single family or multifamily versus like commercial big like 100 unit multifamily. So I'm very much in love of multifamily right now. If I'm still deploying my money, I'm definitely just focused on multifamily right now.
Yeah, and that, that exposure of risk thing is, I think, something that's underrated. And a lot of people actually don't talk about that aspect, but it's absolutely true. Like, I owned a duplex and later a triplex. And even when I had a property management dealing with it, like you said, if you have a slip and fall or something like that, like there is that risk there that someone could try to sue you. Like, even if you put things in an LLC, that corporate veil is pretty thin.
Yeah.
And so what I was advised was to just get an umbrella insurance policy for $1 million, because they're like, it's not a matter of if, it's a matter of when you're going to get sued.
Yep.
So just have the insurance in place rather than try to do, cool legal tricks to hide yourself. And I was like, wow, okay, I appreciate the honesty, but it's not exactly what you want to hear, right? When you're getting started on a real estate investing journey, but you have none of that when it comes to being a passive investor. Hence the name. You are a limited partner. You are limited in your liability because you are not part of the direct ownership team. And I think that's a lot of people, again, they don't think about, they're looking at returns, they're looking at tax benefits, but that legal liability, that's a big issue. And I think if more people understood that aspect who already have a lot of like single family or small multifamily properties, I think a lot of them would make the switch as well.
Yeah, exactly. And also the cost of entry is lower in multifamily most of the times.
Yeah, that's true. I mean, unfortunately, even with getting into a syndication, there's still a barrier of entry, right? If you're talking 25 to 50,000 minimum to get into a deal, that's a big chunk of change. But to your point, if you're having to put 25% down on a property, which is usually the minimum the banks require for an investment property, that's also going to likely be a big chunk of change unless it's just a really cheap. It's one or the other. So you might as well take the benefits of not having to deal with tenants, toilets, termites, all that stuff by being passive rather than having to do everything yourself and still be paying the big chunk. And the other point you brought up is how quickly your profits could disappear. You talked about vacancy, right? You're 3 months vacant. All of a sudden, all your profits disappeared. The same could be said for any kind of major repairs, right? Whether that's a hot water heater or roof replacement, whatever the case may be, that could wipe out your profits for months, if not the year, depending on how thin a margin you have there. And I don't think a lot of people think about that.
Exactly.
They have this formula in their head. I'm going to get, $200 per month in free cash flow after I pay the property manager. And it's yes, but if anything goes wrong, that $200 disappears along with the next $200. So I think that's an important lesson.
Yeah.
All right. So I want to get into how you've been able to leverage some of your background into these investments. You talked about AI, which obviously everyone knows about AI now. It's the new hotness. But have you found a way to effectively use it to help you in, say, vetting commercial multifamily deals?
Okay, so I think the most thing I took out from my job is it's my carefulness or underwriting carefulness or just like rigorous underwriting. I think this is, as a math person or as a scientist, that is my best leverage or my best advantage in this crowded space, because anybody can buy a home at any price, right? Because it's a supply demand market. Whoever pays the highest get the property, but it doesn't mean that the person who pays the highest makes the most money. Maybe just the person make the bad decision of paying so high, right? So I think my advantage of my practice is actually the technology, the mathematic rigorous that gave me the most advantage. Speaking of AI, I personally could not take a lot of it because AI, in order to do it, you need a team to support it. For example, I was at Open Door, which is a iBuying homes in secondary market. And Open Door's business model is basically house flipping. They basically acquire a house, fix it, renovate it, sell it in a 60-day window, right? That business model is powered by a AI model that basically identify homes, which one is cheaper, which one, like how much to buy. So there's an automatic decision of how much should you pay for any homes in Tampa, for example. That saves a lot of time, right? Technically, if I were to build a company that doing multifamily, I can do something very similar. I can say, okay, give me all of the numbers, give me all of the data, I give a price. This is basically the maximum price I can pay at this current moment. Using AI, I'm able to replicate that. But AI is just a more efficient and more time-saving, scalable way of doing something at scale. For me, I could not take full advantage of AI because I'm only underwriting maybe 1 deals or 2 deals a day, sometimes a week. because the Christmas is slow. I don't have to use AI to help me at that. But the mathematical rigorous is the same, right? How AI generate the numbers is similar of how I generate the numbers. So using that, borrowing that statistical framework, help me to underwrite deals very carefully. And that allows me to make less mistakes. So that's the best I can learn from my practice.
Yeah, and I guess I'm trying to think through like how can we, like folks that are on the active side of things, use it to drill down into the best markets and figure out where those are, because sometimes it's the markets that you're not necessarily looking at the most because they're not the most popular, right? Just because it's not the most popular doesn't mean that it's not the most profitable. And so there might be some hidden treasures out there that we're not thinking about. And so how can we collect data sets from like Crexy and all these other paid services and create our own data set that the AI works off of in order to drill down and give recommendations, right? I'm not saying base your investments on an AI, because we're probably not there yet. Help you drill down to where I could do the more rigorous underwriting, but maybe help me identify markets. Do you think that's something that's feasible going into the future? Because I don't feel like I could just hop into ChatGPT right now and say, hey, markets to invest in, because the data set wouldn't make sense for that. I feel like it would have to be customized.
Yeah. To be honest, I think CoStar is probably the best company that can help people to achieve that. It's just a matter of how they decide to monetize their data. Because AI is garbage in, garbage out, right? Like you don't feed the data to AI give you garbage. I think CoStar has the biggest data set right now. And they are the most likely company that can generate this market insight. So if there's a company that's doing that, I think that's CoStar. And there's also another AI company that helps you to do underwriting, right? Basically, I forgot the name, but they do like automatic underwriting. You basically give them like T12, Rainbow, OMs, they output your spreadsheet. But that's technically not AI. That's just basically grabbing data. There's no AI at all. It's all like cookie cutter formulas. So that's just a fancy way of automating things. Other areas of efficiencies, I would say like maybe customer service. You can use chatbot to handle customer service if people want to do it remotely. But I still think real estate is a very operational driven business. You have to have handyman to fix things. You cannot use AI to fix your toilet. So I think a lot of things has to be done by a human, but you can use AI or system in general to make things more efficient.
Yeah, and that makes sense. We are actually on some of the properties using AI systems for things like driving lease up. So if someone goes to the website and they're looking at the property, like you said, more of a chatbot model that is smarter and can follow up and work with people to answer their questions as if a real leasing agent was there, because people want responses immediately. And sometimes that can mean the difference between them renting at your place or just going somewhere else if they don't get the answers that they want right away. So definitely seeing efficiencies there, and then who knows where we could see it next. Obviously, it's helpful to have automation of all types when dealing with tenants so that they get the responses as quick as possible for things like maintenance, right? They want to be able to go on a website, say this is the issue, and then know that someone is going to, a real person is going to come out there and fix it right away, not have to call someone and all this.
Yeah, I agree with you. I think when the GP or the active investor becomes vertically integrated, this is the time maybe like using AI to help solving part of the process issues. But if somebody just starting fresh, for example, if I were to do my own property management company in Dallas, I'm not gonna worry about AI at all, because the cost of building the AI, there's a huge fixed cost to spin it up. And if you're starting, everything is changing. AI is like fixed. Once you build something, if you want to tweak it, it costs a lot of money. So I would not worry about AI until I have a standard process. Most of the company introduce AI at a pretty late stage when they find a stable product market fit.
Yeah, no, that makes sense. Yeah, I wouldn't be seeking to build my own at this point either. I think there's out-of-the-box solutions, companies that are already, and property management companies that are finding these solutions already. It wouldn't make sense for me to try to do it, especially at my skill level. All right, And you talked about how you're a limited partner and you're still looking at deals, underwriting, etc. So, what concerns do you have as a passive investor in this unique environment within commercial multifamily? I'll say.
I would say it's not really a concern. Depends on to me it's not a concern because I'm totally fine of not deploying my money this year. To be honest, I didn't buy any property this year. So I'm patiently waiting. But there are some people whose living is depending on acquisition fee. So they have to close the deals, right? Like, for example, brokers, they have to make a living. GP that doesn't have enough capital, they have to make a living. Agent, they have to, like lending agent, they have to make money. I think these people whose compensation is correlated with transaction, they are in a worrisome mode because right now there's just a huge gap between expectation of the seller and expectation of the buyer. Because the seller doesn't want to lose money, the buyer doesn't want to buy too high. They just cannot agree upon at this current moment. So there's little transactions until the seller is super motivated to sell if he has some financial situations, right? But for me, I'm very patiently waiting just because of right now they are not, especially right now it's winter and also there's just nothing on the market that's super good to sell to buy for me. So right now I'm basically just patiently waiting, but I'm also just practicing underwritings in the meanwhile, talk to people, build up relationship, build up meaningful relationship with GP for future readiness. So I think right now this is like just not enough transactions is one issue. The other issue is that a lot of deals, especially for the properties I'm invested in, Class B, Class C, you will end up with negatively leverage, meaning that your cap rate is lower than your interest rate. Most of sophisticated investors don't want that.
Yeah,
Because
and
most
so
of
I guess
sophisticated investor, sorry.
no, the next question I was going to ask, and you're certainly not the only investor who's waiting on the sidelines. I think
Yeah.
most GPs will tell you who are trying to raise capital this year will say that, yeah, there was a lot of investors who were waiting on the sidelines, as evidenced by how hard it was to raise capital. I guess my question to you would be, what signs are you looking for to know when it's the right time to jump back in?
I think right now it's a good time to jump back in as long as I hit my underwriting numbers, which is 14% IRR, using very conservative assumptions, which means rent growth, organic rent growth is smaller than 3%. Cap rate doesn't decrease. Sorry, it doesn't decrease. And not too aggressive of renovation and not too aggressive of building back of utilities or non-rental incomes. I think if a property can achieve 14% IRR using these four assumptions, it's pretty much a no-brainer still. Because right now the risk of the interest rate continue growing is relatively lower than a few months back. But I still don't want to underwrite the deals that assuming a lower cap rate at exit. That's just betting on the interest rate. And I want to make sure that I can make money even though the interest rate doesn't go down. I don't want there's a better place to bet interest rate. I don't want to use multifamily to bet interest rate. I just want to make sure that I can make money by GP doing a great job. Because over the past few years, a lot of GP didn't do anything and they still get a good job. So a lot of people join the market. I think it's just a matter of who you're working with and also how good the deal is, how much meat is on the bone. So as long as these two criteria get cleared, I'll pretty much deploy a lot of my cash.
Yeah, and I think that makes sense. We're at the point now where I don't want to promise that it can only get better from here, but the operators who are hurting are the ones who got in 2-3 years ago, not the ones who are getting in right now because they've already underwritten for the current environment. Whereas 2 to 3 years ago, we could have, even being conservative, we could have underwritten for this environment because it was, to say unexpected would be an understatement. It's unprecedented. So I think that's the tricky part. But again, like you said, I think the risk of rates going higher is pretty low, but you don't want to be too, rosy on where they're going to go because I don't think they're going to drop low fast.
Yeah, I want to make sure I don't make money purely on interest rate going down. I want to make sure I make money elsewhere on the deal.
Yep, that makes sense. No, and I hear you on all that conservative, especially with the cap rate, right? you shouldn't bet on cap rate. And if you do it to the more conservative side so that you're showing to your investors that you're stress testing to say, hey, even if it goes this way, we'll still be good. We're not going to assume that it's going to go down. All right. And the one last thing that I wanted to hit before we get into the turbo round, you were on a visa before, green card holder now. And I know there's other folks that are listening that are in that same situation, and they may not even know that passively investing in the U.S. is a possibility for them, despite being here, working here, etc. Can you tell me if there are any extra steps required or special considerations for folks that are in that situation, either visa or green card, to passively invest in a multifamily syndication?
Yeah. So I recently got my green card. So you can do whatever you want with your green card. There's no limitations. But if you're working on a visa, which is if you're using a working visa, for me that was H-1B, I'm only legally to spend my time to exchange money for my full-time job. I'm technically not allowed to spend my time to exchange money, which is active in this case, doing something else. Actively house flipping, actively daily trading is considered not technically legal, but passive is always legal. You can do passive everything. You can do passive investment on stock market. You just buy and hold, right? You can do passive investment on multifamily or real estate. For example, all of the single family or townhome I purchase, I'm passive because I just buy and forget. That's considered passive. Okay. But if I'm also the property management, or if I'm doing Airbnb, that's a big issue. So I'm only allowed to do passive investment while I'm on a working visa. But if you become a green card, you can do whatever you want.
Yeah, and that's interesting to me because I assume if you're buying the property yourself, they might consider that active. But, from like a tax perspective, right? You're right. In order to have an active role, you have to be managing it yourself. So if you were self-managing, then that would have been like a red line, is what you're saying.
Yeah, that's right. And also, if you're passive,
I think that's really.
If you're a passive investor of LP, that's by definition limited or passive. So nothing.
Yeah, I think that's really good insight for folks because I certainly didn't know that. So hopefully that answered a question that some people have. All right, we do need to transition into the turbo round. So I'm going to ask you 3 questions that I ask every guest that I have on the show, and I just ask for a quick, honest answer. You ready?
Yep.
All right. What is one red flag that every investor should look out for?
GP skin again. You want to make sure GP interest is aligned with LP's interest. They are not making money on top of acquisition fee. You want to make sure their major compensation come with the performance of the deal.
Okay. Yep. Absolutely. Alignment of interest. And how do you define alignment of interest real quick? I know some people say, it's how much money they have in the deal, skin in the game. But what you're talking about is more compensation for performance. Is that right?
Both. Definitely how much money they take out during the acquisition, how much money they put their own money in. What's the split? Is it 20-80? Is it waterfall? That means a lot.
Absolutely.
And also, sorry, one more thing is how much money do they get compensated by raising money?
Okay, yeah, and people need to make sure that they actually dig into that, and it can be as simple as asking the question like, hey, how do you get paid? As long as they understand that from a basic perspective, they should have a good understanding of how that alignment of interest is. All right, Next question. What is a myth about this business that you would like to set straight?
So there's nothing magic about real estate investing in general. It's just a different investing vehicle. You're not gonna get super rich fast in real estate compared to stock market. Maybe you will get rich faster in crypto, but you get a lower chance of getting rich faster. I think real estate is just a way that you can grow your wealth with very little risk. It's not a vehicle that helps you to 10x your wealth very fast. So you need to make sure the expectation is right. You're not gonna become a billionaire by just passively investing in real estate in 5 years. Just the expectation needs to be set straight.
Yeah, and I think that's really important point because especially nowadays when people want the instant gratification, right? They want to be rich within a year and they'll have gurus out there who tell them they can do it. And I think it's complete nonsense. Your expectations should be 5-year time horizons, 10-year time horizons, and maybe even further, but you can certainly build wealth over the long term. Just don't expect it to happen instantly, right? Like you said, there are a few assets where that could happen outside of random thing like meme coins where you can become poor just as quickly. So there's that risk reward dynamic there. But I do think it's a myth too many people perpetrate that you can get rich quickly with real estate. Whereas that's not what it's about. It's about getting wealthy over time. All right, final question. What does success look like to you?
Yeah, I think success looks like to me in real estate is basically I can keep doubling my money every 5 years. That means I'm doing a great job because doubling my money every 5 years means I'm getting 14% IRR. And if I can spend not a lot of my time, because I'm passive, not spending a lot of my time finding out good investors, underwriting good deals, and I can keep growing my money slowly over there, I'm pretty happy.
Yeah, and that makes sense, right? Like a lot of the deals that I underwrite, that's something that I shoot for on a 5 to 7 year hold. I want to have a 2x multiple. Equity multiple is what we call it. I know you know this, but saying if for those, and there's a bunch of different metrics that we can use to measure whether something is a good deal. You talked about IRR. I like equity multiple because it's so straightforward to explain to especially new investors. Hey, rather than getting into cash on cash and IRR, which takes into account time value money, I could say, hey, a 2 equity multiple means that your investment will double over the whole period. In this case, 5 years. And they're like, oh, okay, I get it. Right? And so it just makes it so much easier. So that's a great one to find success for, I would argue, any commercial multifamily deal. All right, Frank, This has been awesome. We covered a lot of ground from watches to AI to equity multiple there at the end. Please tell our listeners how they can get a hold of you and if there's anything else that you'd like to share with them.
Yeah, right now I'm basically doing full-time investment, and also I'm pretty active on LinkedIn, talking about building up wealth, talk about W2 jobs, talk about personal growth, because I just read a lot of books. I like just growing mindset. And my LinkedIn handle is Frank the Tank CFA, and I post daily about my thoughts, and I'm trying to become just like a education influencer.
Awesome. We will certainly have all that information in the show notes. Again, Frank, thanks for coming on the show, and I look forward to seeing you do big things on your journey to multifamily millions.
Thank you very much, team, for having me today.